Welcome back to the deep dive. Today, we're plunging into the fascinating world of global markets.
Indeed.
And we've got a very specific focus. Silver's, astonishing price movements this past week.
Here's something.
Our mission, as always, is to try and uncover the real why behind those, dramatic headlines you might have seen.
Absolutely. And before we dive right in, maybe a quick recommendation for those of you who appreciate world history.
Oh, yeah.
Highly recommend checking out Hui Wang's A History of China series. It's really comprehensive.
Okay.
It's now covering the Northern Song Dynasty, and it's readily available on Amazon, both ebook and paperback.
Good to know.
Yeah, just a truly rich resource if you want to understand Chinese civilization better.
Great stuff. Thanks for that. And just a brief logistical heads up for everyone listening.
Okay.
We will be taking a short break from July 20th to July 24th.
Right.
But don't worry, we'll be back with fresh deep dives, packed with analysis, right, on July 25th.
Looking forward to it. So let's talk silver then.
Let's do it.
We just witnessed a truly stunning performance. On Friday, that was July 11th.
Right.
During the New York trading session, silver experienced what some have dramatically called a volcanic eruption in price.
A volcanic eruption, wow. What did those numbers actually look like?
Pretty dramatic.
Yeah, they sound eye-popping. London spot silver, it shot up to $38.41 per ounce, which marks an increase of over 3.7% just for that single day.
Incredible jump.
And what's really remarkable here is that this price point, it's the highest since September 2011, so a 14-year high.
A long time.
But the real kicker for me, maybe, if you look at the bigger picture, silver's year-to-date gain.
Yeah.
It's a phenomenal 30%, which has actually outpaced gold's 26% gain.
That is interesting. Gold's had a good run too, but silver's ahead.
Exactly. Does that tell you something maybe about the underlying pressures specifically on silver right now?
It absolutely does. And, the New York futures market, it echoed that same intensity. Silver futures surged past $38, then kept going past $39, eventually closing near $39.
Wow.
That's a 4.3% daily gain in the futures market.
Huge moves.
So the big question, the one on everyone's mind is, what exactly is behind this sudden dramatic surge?
Yeah, what's driving it?
Is this simply, demand outstripping supply? Or is there a more complex sort of underlying mechanism at play here?
Something deeper.
Maybe something we've observed before in other markets.
Well, yeah. If we connect this to what we saw with gold actually earlier this year,
okay,
the underlying reason seems to come down to what's known as a short squeeze in the physical market.
Right, the physical squeeze.
We're talking about just a massive mismatch between the actual physical metal available.
The real stuff?
The real stuff, yeah, and the paper contracts that are tied to it. It's like promising way more cookies than you actually have baked in the kitchen.
That's a great analogy. And what's quite remarkable here when you look into it is just how extreme these leverage ratios have become.
How extreme are we talking?
Well, in gold, for instance, one single physical ounce might back 130 paper ounces.
130 to 1.
Yeah, that's 130 times credit leverage. But in silver, the ratio is even more stretched.
Really?
Yeah, it ranges from maybe 250 up to a staggering 400 paper ounces per one real physical ounce.
400. Good grief.
It makes it pretty clear that any highly leveraged market like this is incredibly vulnerable to what we call physical runs or squeezes.
Right. It almost sounds like a house of cards just waiting for a strong gust of wind.
That analogy fits perfectly, I think. And we're seeing, two key pieces of evidence right now that strongly suggest this squeeze is indeed underway.
Okay. What are those signs?
Well, the first one is the sudden spike in the London silver leasing rate.
The leasing rate. Explain that a bit.
Sure. So this rate, for context, is usually quite low, typically below 0.5%, sometimes even lower than that.
Okay. Very low normally.
But on Friday, it just suddenly shot up to 4.5%.
4.5 from under 0.5.
Exactly. Analysts were genuinely stunned. They said they had literally never seen silver leasing rates rise at such a rapid pace.
Wow. So what does that spike actually tell us about the market's, health or condition?
Well, under normal market conditions, you'd expect arbitrage to kick in fast.
Arbitrage, right. Buying low, selling high across markets.
Precisely. Market participants would step in, profit from those differences, and that would level the rate back down pretty quickly.
But that didn't happen.
The fact that it didn't, or hasn't yet, suggests an acute shortage, a real lack of freely circulating physical silver in the London market.
So the metal just isn't there to facilitate that arbitrage easily.
Seems that way. Now, to give you some perspective, the London Bullion Market Association, the LBMA, they report a total inventory of about 765 million ounces of silver.
Okay, that sounds like a lot.
It does. But when we dig into what's truly liquid, what's actually available for immediate trade?
The stuff you can actually get your hands on right now.
Exactly.
Yeah.
Well, one extreme estimate suggests it could be as little as 7.5 million ounces.
Only 7.5 million.
Yep.
Out of 765 million.
That's the extreme low-end estimate, yes.
Yeah.
And to put that in perspective, that tiny fraction, it's valued at maybe around $300 million.
Which sounds like a lot, but in hedge fund terms.
It could be bought up by just a handful of medium-sized hedge funds. It's not that much in the grand scheme of finance.
Right.
Now, even if you take a more, let's say, generous estimate, maybe drawing parallels to gold's physical-to-credit ratio, which is often cited around 1 to 10.
Okay.
That might place the truly liquid amount at about 70 million ounces.
So still only about 10% of the reported total, even being generous.
Exactly.
Yep.
So even with that more generous 70 million ounce estimate, the crucial context here is that the total silver reportedly held in London, valued at just over $30 billion, is operating with these potential leverage ratios that could be exceeding 200 to 1.
200 to 1, it certainly sounds like it's, well, bound to hit trouble sooner or later with that kind of setup.
It seems inherently fragile.
So that's the leasing rate spike. What's the other telltale sign we're seeing in the market?
The second major red flag is the widening spread between New York futures silver and London spot silver.
Okay, the difference in price between the two major centers.
Exactly. This spread is typically almost negligible, usually under 20 cents per ounce.
Right, pretty tight.
However, on Friday, it jumped way past 50 cents, more than doubling.
50 cents. Okay, that's significant.
And if you look specifically at the EFP, that's the exchange for physical spread, it surged by 20 cents just on Friday to hit 42.5 cents. Again, that is far outside any normal ranges we'd expect to see.
This isn't just minor market noise then?
Not at all. This is a significant dislocation.
And the EFP is really vital here, isn't it? Remind us why.
It absolutely is, because it essentially links New York and London. It makes them operate more or less like a unified market. It bridges that transatlantic gap for both physical metal and paper transactions.
Right. It connects the two pools.
Precisely. So for silver, seeing a 50-cent gap like that isn't just some market quirk.
No.
It's a clear red flag. It signals a major coordination breakdown between these two crucial markets.
And what does that breakdown mean practically?
It means New York futures prices are trading at sharp premiums compared to London spot prices.
Which must hurt someone.
Oh, definitely. This spread directly impacts hedge funds and market makers, especially those who have bet against such moves happening.
The arbitrage players again?
Exactly, or those with short positions. It leads to potentially huge losses for them, unless they can literally ship physical metal across the Atlantic for delivery to fulfill their obligations and close that gap.
Wow, so it forces actual physical movement.
It can, yes.
Yeah.
And we saw similar, quite significant disruptions in the gold market earlier this year, remember?
I do, yeah.
Which also triggered large physical transfers, actual gold bars moving from London vaults to New York vaults to cover those exact kinds of gaps.
So it's like a recurring theme. The plumbing of the market is getting strained.
That's a very good way to put it. The plumbing is strained.
You know, it's really striking how often when things like this happen, we hear about geopolitical tensions or policy headlines. Things like, I don't know, new tariffs, conflicts in the Middle East, blockades, being blamed for these sudden price spikes.
Yeah, the standard explanations.
Yeah. But our deep dive today suggests that might just be, well, a convenient narrative sometimes, wouldn't you agree?
I would.
Almost like a smokescreen to maybe divert attention from a far more fundamental problem.
Which is?
This underlying market stress and the physical squeeze reality we've been talking about.
It does feel that way sometimes. Because, let's be honest, acknowledging a genuine physical metal shortage, that could potentially destabilize confidence in the wider financial markets.
Like reporting a bank run might spook depositors.
Exactly. It's information that regulators and major players might prefer isn't front and center.
So the geopolitical stuff is an easier story to tell.
It can be. And look, while world events can certainly act as triggers, you know, they can be the spark.
Sure.
They're most definitely not the root cause here.
Okay. So what is?
If we connect this to the bigger picture, the real core problem is that inherent high leverage we discussed.
The 200, 300, 400 to 1 ratios.
Precisely. These markets are simply too stretched, they're too thin, to absorb real surges in physical demand without, well, eventually breaking down or showing these kinds of strains.
Right.
The philosopher Hegel, he had this profound idea.
Hegel, yeah.
He said that all knowledge is about necessity and that accidental things are not worth studying.
Interesting. What did he mean by that in this context?
Well, I think what he meant was we should focus on the market's inherent fragility, its structural weaknesses, the necessity of these breakdowns given the leverage.
Ah, I see.
Rather than getting constantly distracted by the random external events, the accidents. Those events, they simply expose the vulnerabilities that were already there.
So the structure makes the squeeze almost inevitable when certain pressures arise.
That's the argument, yes.
Yeah.
The potential for a squeeze is built into the system's structure.
And we've actually seen examples of how these, maybe let's call them quiet short squeezes, gradually expose that market fragility over time, haven't we?
We have. How so?
Well, think about central banks consistently pulling physical gold out of London for their own reserves.
Right, repatriation.
Yeah. That action effectively empties out some of the most important, readily available sources of gold in the London market, bit by bit.
Reducing the buffer stock.
Exactly. Or think about the steady increase in retail demand, maybe through ETFs or physical jewelry buying. That also steadily depletes physical supplies from the broader London and New York system. It's like a slow, persistent drain on the physical side.
Both valid points. It's a gradual tightening of the physical market beneath the surface of the paper trading.
So putting it all together then.
The structural reality seems pretty clear. Precious metal markets, configured as they are, highly leveraged.
Yeah.
They will inevitably face increasingly frequent and probably larger scale physical squeezes.
That's quite a statement. Increasingly frequent and larger scale.
I believe the structure dictates it.
Yeah.
And this raises an important question for all of us watching these markets. This isn't just a series of, unfortunate accidents or coincidences. This structural fragility, this leverage, this is the underlying structural reason behind the long-term rise in the value of gold and silver.
Not just random news events driving temporary spikes.
Exactly. It's something more fundamental baked into the market design.
And what's truly remarkable, maybe broadening out slightly, is that it's apparently not just gold and silver showing these kinds of patterns now.
Oh, what else?
We're seeing similar signs, maybe less dramatic, but still significant, in other metals too.
Yeah.
Platinum, palladium. And even the New York copper market reportedly showed similar patterns and caused a bit of a stir on Friday as well.
How so? Same kind of spread issues.
Yeah, apparently their EFT spreads also widened significantly, pointing to similar kinds of cross-market stress.
Well, that is interesting. So it's potentially a broader phenomenon across the metals complex.
Seems like it might be.
What's emerging here then? What we could be witnessing across these different metals markets? It's truly significant.
What's the takeaway?
Well, all these signs taken together, they suggest a possible, maybe even probable, major power shift occurring in global metals pricing.
A power shift away from
the traditional dominance of London and New York in setting prices through these highly leveraged paper markets.
Towards what then?
Towards a market potentially more influenced by physical supply and demand dynamics, perhaps centered elsewhere or just operating differently.
Okay. So the implication is?
It means we're heading into genuinely uncharted territory for metals prices, probably in the second half of this year.
Uncharted territory.
We could be operating under entirely new rules or seeing the old rules break down significantly. It's really an exciting and I think critical time to watch these markets very closely.
Absolutely. A lot to keep an eye on. Well, that's about all the time we have for today.
Went fast.
It did. We genuinely hope this deep dive into silver provided you, our listeners, with some valuable and maybe surprising insight into what's really happening beneath those headlines.
Yeah, hope it was useful. And just one last reminder to check out Hui Wang's A History of China on Amazon if you're interested. It really is a deep dive into civilization.
Great. And just that quick reminder again about our short break. We're off from July 20th to the 24th.
Correct.
We'll be back with fresh, in-depth analysis for you on July 25th.
Looking forward to it. Until then, take care, everyone.
Take care.